We're delighted to have you here to talk a bit about where insurance products, morbidity, mortality products are going given the current landscape and the turning points that seem to be taking place in that arena. We have an outstanding panel that is eminently qualified to discuss the various impacts on this. I'm going to introduce each one before they take a few minutes to talk a bit about their specific areas. Some will use PowerPoint, some won't. When they're finished, we have some questions we would like to direct to them, and we would like to come to you in the audience and ask you to come to a microphone if you have some questions you would like to direct at the panelists as well. So starting off, and we're going in alphabetical order, so it's not of any particular importance because they're all important people. Joanne Abram, who is the current CEO of the Alberta Insurance Council, and in fact has been the CEO since that organization started in 1989. Her career has taken her into a lot of various involvements in insurance regulation in Canada, as you can tell from her bio, including work with Cicero CCI and the development of the LLQP. In my experience in traveling in Alberta, I find that the attitude the Alberta Insurance Council takes towards advisors and the various intermediaries they deal with to be particularly open and a terrific one to deal with. And personally, although I guess we have to be careful not to play total favorites in this game, Joanne is as favorite a regulator in this area as I can find in the country. So Joanne, would you please start us off?
Thank you. Thank you. I appreciate the opportunity to be here. The theme of this conference is turning points in shaping our future in insurance. And in thinking about this topic, the topics of the value of advice in the face of shrinking product shelves was also an issue. So I'd like to give you my thoughts on some of these issues from the perspective of the Alberta Insurance Council. And I'd like to qualify them by saying I'm able to address regulatory matters only as they pertain to insurance distribution, not securities or mutual funds, although I'm sure many people in this audience have those licenses as well. For those who may not know, the role of the Alberta Insurance Council is to administer and enforce legislation and regulations in the province of Alberta. This regulation governs agents, adjusters, and brokers. Our organization is responsible for licensing and compliance for all of these individuals. Currently, right now, we issue over 40,000 certificates a year. The Life Insurance Council is composed of 2 agents who are elected, 2 life company representatives, and 2 public members. This is, in essence, a peer review panel. So we are not a lobby organization. We're not consumer advocates. We sit at the center. We make sure the insurance industry in the province is operating at the highest standards, and in doing so, we protect consumers. And it's from that perspective, the consumer protection point of view, that I can speak to the issue of product access. Certainly, we've seen considerable evolvement in the insurance marketplace over time. Much of this evolution predates the financial crisis and the economic downturn. And it predates the period of record low interest rates that have come about as governments try to stimulate economic growth. For example, with the rise of the internet, consumers have had increasing choices for purchasing insurance online. These online options are usually marketed for their speed, ease, self-service aspect, and affordability, sometimes with a cut-out-the-middleman pitch to them. Consumers are also increasingly presented with specific one-off insurance products tied to purchases at the point of sale. Financial institutions will offer them life and disability insurance on a mortgage, similarly when they get a line of credit. Also, when a consumer buys a vehicle using financing, the car dealer will offer insurance policy on the car loan. Even funeral businesses are now offering life insurance to cover the costs of prepaid funerals. Sometimes consumers will take advantage of these one-off products out of fear or prudence, especially as a result of the timing. They're signing a significant loan, or in the case of a mortgage, probably the largest debt they'll ever have. And the bank or car dealership gets them thinking about what happens if they get sick or lose their job and can't pay. Against this backdrop, the provision of insurance advice is more important than ever. Many times, a consumer applying for insurance online or buying a specific one-off product is not doing so in the context of an overall financial plan. That can have consequences for them later. Their coverage under those types of contracts may not be suitable, or those policies altogether may very well end up costing them far more than if they had put in place a comprehensive overall financial plan. In addition, the exclusions and restrictions and limitations on some of those policies may well mean that they're paying for coverage which would not respond as expected should the need arise. We have to remember that the underlying principle to insurance is at most good faith. When purchasing insurance, a client is purchasing a promise that they will be indemnified against the loss in the event of a specified peril. It's not a product that they can test drive. And by the time they know whether or not they've bought the right product, it's generally too late to change it. So it's essential to the business of insurance that participants command and maintain confidence and the respect of the public. The giving advice is critical in this process. There's an old saying that nature abhors a vacuum. If agents and brokers are not going to be there to advise their clients, and insurers are offering less in the way of products available, then someone else is going to step into that void. That vacuum gets filled with online options, one-off insurance products, and so on. Now, seen in that context, the issue of insurance companies offering a shrinking shelf of products becomes a consumer protection issue. A byproduct of the shrinking shelf is that there is no advice giving and a widening of an adviceless void that other service providers will step in to fill. Consumers aren't benefiting from professional insurance advice and comprehensive insurance planning to the degree that they otherwise might. I can't provide expert comment on how much the regulatory climate is responsible for this shrinking shelf effect. What product categories and product lines to offer and how to offer them are all business decisions, and many factors weigh into that decision. However, government regulation is certainly part of the calculus that goes into business decisions. So it's important that we have the right regulations in place with the appropriate focus. That doesn't mean the absence of regulation. Regulations have a time and a place. You just have to look at the US experience to see the consequences of too little regulation. We don't want an anything-goes environment when it comes to insurance. As I said earlier, it's a business where clients are depending on a good faith promise, and they make choices in their day-to-day lives based on those promises. The public needs to have trust and confidence in the industry, and government regulation is one tool among others that plays a role in providing that. On the other hand, there's a tendency for government to enact regulations in response to incidences or specific crises. It's a dramatic way of showing the public that they're taking action to fix things. Unfortunately, it's also highly reactive rather than proactive, and it doesn't necessarily result in a better system. At times, that reactive approach will have other unintended consequences that weren't considered in the rush to enact regulation. One of those unintended consequences can be a less competitive business climate, or in some cases, businesses deciding to get out of certain areas or carry fewer products. It wasn't that long ago that copious levels of disclosure was thought to be one of the most effective regulatory tools. All tools, however, have their limitations. I'm sure you can all remember the basic disclosure statement, which was required to be used in incidences where you were replacing one policy of insurance with another policy. These were very long, technical, and very detailed forms, which we as regulators soon found out most clients signed without understanding what they were signing. It didn't take too long for us to realize there is a chance you can be disclosed to death. This was supported by an article which appeared in Forbes.com a number of years ago. Talked about the British retailer GameStation. As part of an April Fool's Day experiment, GameStation added an immortal soul clause to their software licensing agreement, with the result being 7,500 online shoppers signed over their rights to eternal life. In the agreement, notice of the transfer was supposed to be announced in 6-foot-high letters of fire. Consumers who read the clause and chose to opt out of it received a £5 discount on their next video game purchase. Only 12% ever did, proving GameStation's point that most people agree to terms and conditions without reading them. On a positive note, governments have been shifting to risk and outcomes-based regulations. This means moving away from highly prescriptive legislation that spells out exactly what must be done and how it must be done, in an attempt to control exactly how people and companies do things, and instead moving towards legislation that focuses on managing risk and articulating the outcomes that we want to achieve. That is saying, how you do it is up to you, but here's the expectation that we have at the end of the day. This approach enables insurers to be creative and innovative in the way they run their affairs and in the products that they offer to consumers, while at the same time managing risk and ensuring the insurance business maintains integrity, competence, and good faith. Regulating proactively in this fashion also enables us to be more strategic in addressing issues and challenges. Using a blanket regulation to get at a particular issue is like using a flamethrower to kill a weed in your garden. It's overkill, and it takes out a lot of good and promising things that are germinating. Regulatory resources are limited. It makes sense to target our regulatory efforts and our resources on the most significant issues that pose the greatest risk of harm to consumers. By focusing on the greatest risks and aiming at the areas where we can help protect consumers best, we can ensure the public maintains trust and confidence in the industry while keeping the insurance climate competitive. Other initiatives of late have been designed to facilitate business. The agreements on internal trade and other trade and labor mobility agreements facilitate harmonization of educational standards and allow for agents to conduct business in any number of provincial jurisdictions. These are all positive initiatives designed to ensure adequate levels of consumer protection while allowing business to function with appropriate oversight but minimal government interference. Again, I appreciate the opportunity to be here, and I look forward to your questions.
Thank you, Joanne. I hope you all now can see why I consider Joanne to be such an enlightened regulator. Thank you for bringing us that view. We're now going to turn to a view of regulation and compliance from the point of view of a company and a manufacturer distributor. We're joined today by Ann Butler, who is Senior Vice President, Corporate Counsel and Corporate Secretary, General Counsel, Corporate Secretary at Empire Life. I just met Ann today for the first time. We've been able to share some thoughts as the day has transgressed. But I've discovered in preparing to introduce her that not only do I, but several of you in this room have an awful lot in common with Ann. Because as the bio says, Anne is not only the legal counsel, but she is also the governance, legal counsel, and compliance, but she's also in charge of her responsibilities as the chief anti-money laundering officer,
That's
the
an
chief
exciting one.
privacy officer, the chief compliance officer. You probably see where I'm going. In my firm, I'm all of those things as well, Anne.
Yes, I know.
Unfortunately, I don't have the same support that you do in terms of the staffing. And before she came to Empire, was in private practice in Ontario, involved in issues representing insurance companies with claims in the area of disability and life insurance. So she can bring the perspective very well, I believe, to where we are in terms of the company and the compliance and the regulatory arena that they deal with. So Anne, if you could give us some comments here or there, whichever you're
I
most
think I'm
comfortable
going to
with.
sit here if that's okay. I guess first thing I should do is confess that I'm a little worried now that I should go back to my iPad and check the agreements that they make me say okay to every once in a while, because I've become quite desensitized to that particular online agreement, and I'm sure there are many other people, including lawyers in the room, who might be feeling that way. And so thank you, Joanne, for not only being very enlightening about regulatory issues, but also legal issues for us here today. I'm actually here speaking, as it's been said, I wear a number of hats. Some people tease me and call me the chief back at the office, which is, I think, intended to make me feel small. I'd like to talk not only as professionally, I'm a lawyer and a chief compliance officer, but also as a member of the executive team at a mid-sized company, not a big company. That's why I have to wear so many hats, right? So what I wanted to do for a moment is to take us away. I've been here all day, so I did actually have a slide deck, which I turfed at the last minute because I wanted to speak about some other things that have come up as I've been sitting through the sessions today as well. So I'm trying to work in some of those thoughts through this process. And I wanted to take us back up to 50,000 feet for a little bit and look at the international regulatory environment for a moment, and then bring us back down into Canada and what's going on in Canada as a result of that, and then connect to what's happening for you as advisors in this environment, and some of the themes that I was very pleased to hear today coming out of the mouths of regulators about the importance of advice for consumers in Canada. So let me take us back up let me take me actually overseas to Brussels, to the G20, to the things that happen overseas in the international political world, and as I like to call it, what happens in Brussels doesn't stay in Brussels, because what happens in Brussels or in the European place where all our ministers tend to go off to fun places to meet is they come up with policies that we end up having to live with here. And our financial system is very respected. We have now, one of our guys is the leader of the Financial Stability Board, which is great for Canada. We are, though, as a country, we are part of the international financial scene. And what happens there comes here, and it becomes very real in our lives. So what's happening overseas with respect to the need to regulate the financial services environment, we all lived through 2008. We all know what's going on in Europe today. Those things are impacting us in a very real way here in Canada. And they're doing that through the structure internationally, through the FSB, into the International Association of Insurance Supervisors, where we're very well represented both by OSFI and by the AMF. And they are creating policies and guidance, standards and guidance that are being brought into Canada. And those are some of the things that people like me, wearing the responsibility for compliance, are living with. People like some of my colleagues. There's another lawyer on the panel, but there's also an actuary, right? You're an actuary. Yes. Yeah. So actuaries are living through this in a very real way as well in our industry. And what's happening is capital requirements are becoming something that our regulators are very focused on after the financial crisis. We have a lot of focus on governance for all of us. Many companies that are also are in the banking business as well have already gone through a lot of these changes. It's hitting the insurance company now. There's a lot more activity for us as people in the regulatory affairs or compliance or legal area. It means a lot more activity that's impacting products in the Canadian marketplace. And you as financial advisors, where you're experiencing that is in what's available to you for your customers in the Canadian environment, and who hasn't seen some big changes in what's out there from insurance companies in the past year right? There's been a lot of change in the marketplace as a result of that, and that is driven by not just our passionate local regulators, but by international standards that are coming into Canada. And it's not just international standards that are driven by true governing bodies, elected government, but also by the International Accounting Standards Board, who has fundamentally changed the accounting rules in the world, except for the US, because they have their own little world, or very big world, I guess you would say. And those have been very, very fundamental to what we're offering or able to offer now in Canada in the marketplace, because the rules under international financial reporting standards have not been well designed to contemplate a business that has to plan to honor promises 80 years in the future. So we have assets and liabilities being marked to market every quarter. Things are bumping up and down. You're all living through people going like, what's going on with the performance of these companies quarter to quarter. These financial standards are really fundamentally changing the game for us in terms of the financial reporting of our companies, but also with the regulators, because the capital requirements similarly are going through the same thing. So it's a very, very challenging time for companies to be operating it and handling products. So that's a very real impact for you. And I love the fact when we first prepared for this session, I heard you say it at that time on the phone, to hear a regulator talk about the fact that a shrinking product shelf is a consumer protection issue. It's so true, and we should be talking about that. I think that's one of the best points that you heard today, that we need to make sure we're educating our regulators about the impact of some of these rules upon the consumer in Canada, not just the companies, not just the advisors, but the consumer in Canada. So that's for me, was a real nugget in terms of the things that I've learned through this process, and I want to thank you for that comment, and I'm going to ask you to sign a petition for, and maybe pass it around to your friends. Is that okay?
No problem.
Yeah? Okay.
No problem.
So another, the other international development I think is critical for us as insurers, for us as advisors to understand, is what's going on from the insurance regulators in terms of their focus on commercial practices, or what's become, if you hear the phrase treating customers fairly, that is the international standard that is driving the review of commissions, that's driving the review of disclosure, those kinds of things. So that, again, it's an international standard. It's coming into Canada, and it's coming in, being implemented now. We've had focus from the CCIR, Canadian Council of Insurance Regulators, on a number of things, including their review of the MGA channel. And I think, in fairness, they were very careful and did a detailed review, and they didn't find a lot of serious problems out of that process. That's a similar thing that Canada's experienced in the past. Remember when everybody was concerned about the insurance practices in the US? So there was a study in Canada. There was a finding that we really weren't the same environment. We weren't doing the same things that were happening down in the States. So we have now also in Quebec, the commercial practices guideline is very much the implementation of that standard. And we have regulators like Fisco and the other provincial regulators have signaled that this is now a big process for them, because they have to, Canada has to comply with these standards. So what's on the table now is, how are we going to comply with these standards? And that is to me an opportunity for us as an industry, an opportunity for you as advisors to start getting the dialogue around the value of your advice out there before the regulators, before the policymakers, to make sure that the way that Canada implements these fits with what's happening in our country. So that things like, as an example on the capital side of the house, that new changes in accounting rules don't inadvertently make certain products no longer profitable for companies to sell in the way they were selling them before. For instance, some of the long-term guaranteed products have been very pressured in the past year. There was a lot of discussion today around the value of advice. One of the questions for Rick in the last session was around, what was the impact of some changes to compensation models, and have there been any studies of those kinds of issues? And there was an interesting study. Now, these weren't independent academic studies that will go through 2 years of peer review, though, so let me just preface my comments with that. But this is a little bit of information on what happened in the United Kingdom. So if you look at what's expected to happen as a result of, for instance, fundamentally changing the commission rules in the United Kingdom, that there's an expectation or the analysis from an article in the Plan Plus Investment Executive July 2012 was that it would cause approximately 30% of the advisors to be leaving the business, the change in model of commissions. If you're in an environment where our public policy makers believe that Canadians need advice, they have to be very careful about changes they make to commission, to the ways in which financial advisors are advised. Again, this is not peer-reviewed independent research like the great presentation that happened just before this, but it's a sign of this needs to be thoughtfully considered when our regulators are considering making these changes. And I'm not saying that this current system is perfect. What I'm saying is we should be careful to understand the implications of changes and not make changes because they did it in the UK, or they did it in South Africa, or they did it in Australia. Those are the kinds of things we need to make sure don't happen in Canada. Another example from an article called The Conundrum of Simplified Advice, the Investment, Life, and Pensions Money Facts in July of 2012, answered the question earlier about how much does a consumer think advice is really worth. So here's a snapshot. We don't really know the real answer to this question. It's certainly in Canada, but in the UK, the cost of actually giving a financial health check, they call it, to a consumer in the UK, the actual cost was around £670, $1,000 Canadian. And when customers were asked that, they gave it the value, a range of £0 to £50 or $80. Right? So there's a disconnect between what the cost is and what the perceived value is. And that is maybe a concern or an opportunity for us to start, again, making it clear, helping to educate the public, your customers, about the value of your advice, and helping to educate our regulators and our policymakers about the value of advice. So from a perspective of somebody in my position, what I guess I worry about if I take off my compliance hat and put on my executive team hat, I worry about how much time we as companies are having to spend on responding to, concerned about fundamental game changers that are happening in the regulatory environment that are in fact driving strategy, perhaps, certainly product design, rather than customer need, competition, the typical things that you would hope are going to be your bigger concerns as a company. Regulatory issues have become a huge concern for us as executive teams. And there were 2 studies in 2011 that really called that out. There was one from McKinsey that spoke about the executive team were of the view that regulators were second only to customers in their ability to affect the economic value of a company. Second only to customers was regulators, okay? And the other was from the Banana Skins, you love the name of that report, Banana Skins, which said that the executives of insurance companies said that regulation was the biggest risk that they were facing. And recently in PwC this year in 2012 had a study where it showed the study this year had, what's going on in the world economy with Greece and Spain and all the other things that are going on, and what is the impact going to be, and regulation. So, as an industry member, as a company, this has become one of the critical concerns that we have to cope with every day. It takes a lot of energy. There's a lot going on out there, and it's something that we have to, I believe, we have to understand. We have to pay attention to what's happening internationally. We have to understand it. We have to understand what it means in our country so that this doesn't become a race to the bottom, that we end up with whatever regulation happened over in South Africa or UK or whatever, without it making sense for our economy. We have the best financial system in the world. We should be understanding what makes it great And we should make sure that when we import these principles, that we're applying them in a way that makes our economy and our financial system better, not bring it down to the level of one of our peers that might not be doing as well as us internationally. I see that as a huge opportunity for us, but it's a lot of work. You have to, there were some comments here today about the need to get the message out. I do think, for instance, that this report that was described by Rick just before this session is a great thing for us to be talking about. I agree that the industry should be talking about it more, and it was whispered to me that perhaps I should be talking to my boss about that, and I shall do so. But that for me is what it's all about, or what it's like to be sitting in my chair with a lot of hats on. That's it for me. Thanks.
Thanks, Anne. We're hearing from the regulatory side, and I'm learning an awful lot today, I have to tell you, and I was glad to see Joanne, your head nodding a few times. That's very encouraging, but when I came here, I always used to think, as far as the clients went, what they don't know won't hurt them, and I'm learning that maybe that's not the attitude to be taking. Just a little joke. Really pleased our next panelist could join us today. Steve Krupitz with Manulife. Joined in the Actuarial Services Division in '82, and in the intervening years, his career has taken him through a path where he has been involved in pricing and dividend determination and working in the areas of all the lines of products that we as advisors work with. And he currently also holds a position Assistant Vice President, Actuarial Consultant in Northern Eastern Ontario, as well as Atlantic Canada. So you can see that this kind of a background, Steve comes equipped with experience and technical knowledge that can really talk to the issue of product in this environment. I'm also pleased to note that he follows along in what I have observed to be a bit of a Manulife tradition for their executives, in that they wear very sharp ties. Steve, it's your turn. Would you like to come to the podium? Or?
Good afternoon. All right. Good slides. It's the right ones. I think I'm going to be a little bit briefer, or more brief than the first two speakers, because they've covered some ground that I intended to speak on, and I'm not going to reiterate those comments, particularly Anne's on this first slide. As a manufacturer of product, insurance companies have been under unprecedented pressure in the last 5 or 6 years in terms of the changes in the regulatory world, the pressures on capital, the changes in international accounting, and the impact on product. You've all seen it. Products have changed on the street very, very rapidly. Still changing. I'd like to tell you that the dust has settled and we're all done. I'm not sure that's the case. A little bit of a caveat to start with. I'm talking to you while Manulife's all over my slides and everything else. I'm giving you my personal opinion. I'm giving you my personal insight. I am not telling you what Manulife is working on. I'm not hinting on where we're going. I am going to do a little bit of forward looking, which I know we don't do as a public company, but this is my opinion. So with that caveat, this pace of change has been unprecedented. It's put huge pressure on insurance companies and inside the head offices in terms of reacting to what's been happening in the regulatory world, in the accounting world, and in the economic environment in terms of low interest rates. We are at historically low interest rates. Government of Canada 20-year bonds. I've done this presentation out in the street, and several of you in the room have heard me talk about how interest rates in Canada are the lowest they've been in history probably. And that's having a huge, huge impact on the capital that we have to hold, and it's caused us as a manufacturer of product to rapidly change our products in terms of repricing the products that are out there, raising the cost of insurance on our guaranteed products, weakening the guarantees that are there, and withdrawing products. And I know that the product shelf has been shrinking. I'm not sure that everyone would agree on the extent to which it's been shrinking. There's been a little bit of light at the end of the tunnel. I think that there has actually been, where the shrinkage has attached a lot of attention, or has attracted a lot of attention, the companies have at the same time been trying to dress up other pieces, have been trying to improve some of our other product offerings. It hasn't received the same press. It hasn't received the same attention in your community, in your client communities. and not even necessary within the insurance companies, but we've started that process. And I think that that's where we're headed. I think what you're going to see is companies accelerating the product development. We've been reactive. We're the recipients of unprecedented pace of change, unprecedented low interest rates, and we've had to react in terms of the products that we're offering, the guarantees that those products provide. And we're starting to turn the corner. I'd like to think we're done. I'm not sure that's the case. But I think what we're going to see is a little bit more in terms of innovative products, new products, things that are going to give us a little bit more option. Hopefully that's a good thing for our consumers. It's certainly going to keep a lot of actuaries employed in a lot of head offices around the industry, which is good for my profession. I think what we're going to see, however, is that those products are going to be different products than we've seen in the past. There will be if I look at my employer's product shelf, on the individual life insurance side, we provide half a dozen or so products between term and permanent coverage, and that has shrunk by 20 or 30% over the last 3 or 4 years. I think the direction that you're going to see is more and more nuanced products that are not as complex as what we've provided before. In terms of focusing on advice, I think your role as advisors in terms of selecting insurance products for your clients, recommending insurance products for your clients, has been looking at, within each of the providers that are out there, within each of the manufacturers that are out there, a relatively small product shelf, but where the products on that product shelf provide a great deal of flexibility and a great deal of option. And your advice has been around, let's pick the right product and let's figure out how to use it and how to modify it going forward, and how to manage our clients' changing lifetime as they go through this product and make sure that that product works with them. Because of the regulatory changes, because of the pressure on capital, I think the direction that you're going to see the industry going in is to provide more products, but narrower products with tighter focuses. So instead of a relatively small range of products with a broad range of options within each, we're going to see a broad range of products with narrower options within each, because in order to control the risk, in order to control the capital exposure, in order to control the guarantees, it's easier as a manufacturer if I have a smaller set of risks that I have to manage within each of those products. So I think your advice, if I'm right in this, and as I said, this is my personal opinion, I'm not telling you what Manulife's working on, is that your advice is going to go from picking the right product, but focusing more on the options within that product, to a broader range of products and selecting the right product and managing that product somehow through the changing needs and circumstances of your clients. And it will be a different sort of skill that you're going to need, or a different sort of insight perhaps that you're going to need as we move through that. I think those products are going to be priced for the economic environment and the capital requirements that we see today, and perhaps in the near future. We are not going back to where we were before 2008 and 2009. Even if interest rates do go back to where they were a decade and a half ago, I'm not sure that the product suite that is being provided by manufacturers is going to go back to the product suite that it was 5 to 10 years ago. Just as the world has changed with what we've come through economically in the last 5-10 years, I think the manufacturer of the products have changed, and the products that we're going to put on the street have changed. So it's going to present more opportunities for us. It's going to present more challenges for us. I want to close with a pat on the back to some of our regulatory approaches in Canada relative to what's going on internationally. And I know there's been a lot of differences between what happens in Canada and what goes on internationally, as both of the earlier speakers have commented on. But I think for a large part, we've benefited in Canada from the fact that our regulators are largely independent of the political process. Some of the, I'm trying to be political here, some of the regulations, some of the legislations that we've seen passed in other jurisdictions might fall under the knee-jerk reaction to some of the things that have happened. And I don't think we've seen that in Canada. I think we've had a more thoughtful process, a more collaborative process, where they've talked to the industry, where they've talked to providers, where they've talked to advisors, and sought input in order to make sure that what we're doing is not a fast political expedient response to current issues, but a more long-term, more thought-out process. It doesn't always seem that way, and then certainly over the last 3 or 4 years, I'm not sure that the pace of change of the industry has put in your laps in terms of how we've repriced products is evidence of that. But I think behind the scenes it is true that we've been more careful on the regulatory front in Canada than has necessarily been the case internationally. That does leave us with a bit of a challenge internationally, and that isn't the focus of today's agenda, but it has been a challenge for Canadian companies relative to our international competitors. And any of you who are dealing with clients who have cross-border opportunities will have seen this, that the pace of change in Canada has been more rapid than it has been to our friends to the south of us, because they're not they're not adopting the same rules with the same speed that we have. I suspect, and from my reading of the literature and some of the stuff on the actuarial side, I believe that there will be a convergence and that those international differences will smooth out, and we're going to come to some happy medium between everything. Where it ends up, I don't know, but right now it is a bit of a challenge, particularly for any of you who are dealing with clients who have opportunities on both sides of the border, because the product suite in Canada is changing at a different rate and providing different values than is necessarily being provided by our competitors in the US, because they're not on the same page that we are. Anyways, I'll stop there and turn it back to you.
Thanks, Steve. Appreciate your comments, Steve, and we'll look forward to a little more discussion about the advancement of products. There are some of us in the room, I confess I have to number myself in that used to deal in a day of much, much more simplicity. We would, after watching a lot of movies in the afternoon, go out and see some clients in the evening. We would have a briefcase that would include an abacus, something called a rate manual. Believe it or not, they used to have something called rate manuals, youngsters. And then we would have probably a stash of papers that you could apply for maybe 3 permanent product, 4 or 5 different term products, and a non-can and a can disability product. And we would take those sheets of paper and fill them out and send them off with the carrier pigeons to head office. So moving along in the advancement, we look forward to see exactly where we're going to go in that area. And now to speak to us from the point of view of advisors and their clients in terms of the change and the shift in the environment of products and services is Kevin Wark, who is, I'm quite sure, familiar to virtually everybody in this room as a colleague and a friend. Kevin recently was appointed as the president of the Conference for Advanced Life Underwriting, CALU, a sister organization to Advocis. Previous to that, many of you will know, he worked with many of us in developing cases and was an executive in distribution and planning services in several MGAs. Has written on the topics of insurance and estate planning, charitable giving, and taxation, etc., and is a constant presenter in many arenas in that particular area, eminently qualified to discuss in this particular area where we're going and what's happening. So Kevin, if you could please, wherever you're most comfortable, present.
Thanks very much, Chris. Good afternoon, everyone. Hopefully after that introduction, I don't disappoint. But I am going to take a look at this from a bit tighter focus than Chris perhaps might have suggested, and that is the issue of how tax policy is impacting the insurance industry and will continue to impact tax or product development in the future. And this is an area that CALU spends a lot of time thinking about. I know our chair is here. I know Terry Zive, head of our Government Relations Committee, is here. We have a number of members that have a role in looking at tax policy as part of the broad scope of government policy. And in fact, we have a very strong relationship with Advocis in terms of working together in this area. We have a joint Government Relations Committee comprised of Greg, Dean, Chris, Ed, and Peter from the Advocis side, Simon and Terry and myself from the KLU side to make sure we're aligned and understand each other's priorities on a regulatory front and can support each other. And it's been working very effectively to ensure that we are focused on the right issues on behalf of our membership. So we've got this great relationship that's going on that is paying off for both Advocis and for KLU members. So we've heard today about how many regulatory issues are impacting the insurance industry. In fact, our industry is probably in the midst of its own Hurricane Sandy, the perfect storm with gale force winds, driving rain, and high tides that are lashing at insurers, distributors, and consumers alike. A combination of global financial uncertainty, increasing capital requirements, and other regulatory issues have forced most insurers into seeking the higher ground, resulting in price increases, reduction in product guarantees, and even the withdrawal from certain product lines. In the midst of this, our industry is facing another regulatory challenge that is not often mentioned or discussed and is not even in the description of this session. In the past 3 years, the insurance industry has experienced an unprecedented wave of tax legislation and audit activity. The last time the industry was under such increased scrutiny was in 1981. Now, I know that was a long time ago, but I know a number of you were around for that and understand the importance of that date, which is when they first introduced the exempt test rules for life insurance policies. So we have all of these things hitting the industry, and on top of that, we've got significant change from a tax policy front about to hit us or is already impacting us. Why is this occurring? Well, the federal and provincial governments are undergoing the same sort of environment that the financial institutions, business owners, and Canadians are experiencing generally. They too have funding issues due to the recent financial downturn and the requirement to enhance funding for a variety of public works. Low interest rates and stock market uncertainty are also impacting them as funders of public organizations, pension plans, and things like that. The aging population, which is living longer, also has an implication for our governments. We have higher unemployment, which results in reduced tax revenues, a shifting workforce, and different employment patterns. There is now an international and interprovincial focus on tax avoidance structures, and there's a loss of confidence in the ability of financial institutions to self-manage themselves, and even, sorry Joanne, in some of our regulators. These challenges and the prospective government reaction to each of these will in turn impact the future of product development in the insurance industry. We're already seeing a number of trends in terms of tax policy that are affecting all of us in this room. There is the upward increase in tax rates, at least provincially. We now have a surtax in Ontario for high-income earners, and Quebec has also implemented a new tier of tax rates for higher-income individuals. Most of the provincial governments have frozen the tax reductions that were to be implemented for corporate tax rates, and some are now even increasing tax rates on corporations. We have the expansion of retail sales tax and HST to certain financial transactions and intermediaries. There's an attack on international and interprovincial tax planning strategies. There's a lack of faith in the general anti-avoidance rule, which was to prevent abusive tax planning strategies. And instead, they are introducing very specific anti-avoidance rules, which unfortunately are overly broad in their effect. There is the reintroduction of rules. I'm not sure if you're aware of this, but in 2010, They introduced rules for reporting aggressive tax planning strategies. That disappeared for a couple of years. That was just recently reintroduced with an effective date as of 2010. The modifications to the old age security and the cutbacks on federal pensions for civil servants and MPs are all indicators of the concern around the longevity that's impacting Canadians. Then we've already heard about initiatives to fund financial literacy on a federal level, all with the goal to making Canadians better informed so that they can make more reasoned financial decisions. What does this mean for the insurance industry? Well, we've got increased scrutiny of tax-motivated insurance planning strategies. We have an announcement relating to leveraged insurance strategies and the fact that the Finance Department has it under review. We've got new legislation relating to retirement compensation arrangements, which have been funded in the past with insurance products to shut down unintended or abusive tax planning strategies. The expansion of the federal and provincial tax base includes the tax treatment of additional types of employment benefits, such as the rules that were recently introduced governing group sickness and accident insurance plans. There is a focus on private company sponsored benefit programs where shareholders and family members are participants, and legislation such as that relating to employee life and health trusts, individual pension plans, and employee profit sharing plans, all designed to influence how shareholders and family members participate in these types of programs. Changes to retirement income programs. I've mentioned OAS, we heard about PRPPs today. Review of the exempt test rules. This was announced in the federal budget of 2012, and the industry has been actively engaged in an extensive process of reviewing and commenting on proposals that will impact not only the exempt test rules, but virtually every element of the policyholder tax rules in Section 148 of the Income Tax Act. And just as they're introducing specific anti-avoidance rules relating to non-insurance types of programs, they're also being introduced for RSPs, RCAs, and possibly exempt insurance policies. As a result of these rules, insurance companies will need to review and possibly reprice all of their current products. They'll need to release new marketing software so that you can illustrate those products. They will need to revamp all of their internal tax reporting and administrative structures, a significant effort on their behalf. The insurance advisors in this room will need to learn a new set of tax rules and will need to understand how those rules apply to current products and how they may apply to existing products. Because while we can anticipate that current products will be grandfathered from the new rules, there will be certain transactions which may result in them losing their grandfathered status. Through this process, certain products will become less attractive. Alternatives will have to be sourced, reviewed, and vetted before they can be put in front of your clients. So I hope I haven't depressed you too much yet. Because there are opportunities. Clearly, we have a lot of innovation in this industry. We've seen it time and again. In 1981, when they introduced the exempt test rules, the industry went on and has grown and flourished. We have to continue to focus on what we're good at, which is creatively insulating Canadians from the risks of dying too young or living too long. Too young or living too long. And we've already seen products introduced, and we'll probably see more, where there'll be combination-style products to allow for various coverages and pricing breaks because of the interaction between those products. We'll also see products that will change and transition as people grow older, such as a disability policy converting to long-term care when it's required. As an industry, we need to do a better job of education. We need to educate our advisors, the consumer, government officials, and MPs on the social and economic benefits of our products. And through this process, we not only have to project forward what we need, but understand what the governments need, what their tax policy goals are, what they are trying to achieve, and work with them to help them achieve their goals. And that requires us getting very close to them and being able to respond quickly to what they're putting forward to us. So not only must we build trusted relationships with our own clients, but we need to reach out and build those trusted relationships with all regulators, including those in the Department of Finance and the Canada Revenue Agency. So hopefully in 15 minutes or so, you have an appreciation of the need to be involved and actively engaged in the tax policy development process. We at CALU have repositioned ourselves to play a much stronger role in this area, and we're looking forward and confident that we can weather this storm and be stronger for it. Thanks very much.
Thank you, Kevin, for your usual very, very good job. Now I'm going to pose a couple of questions to our panelists, but then we are going to open it up to the floor, so if you have some thoughts or want to jot it down, questions for them, then please do so. And the first question I'd like to direct to Steve and to Kevin, but I want to invite all the panelists to give me their comments from their own perspective. In North America, and particularly in Canada, we have a history of long-term guarantees on life insurance and living benefit products. Now manufacturers are facing challenges on many fronts, such as we've discussed today: low interest rates, increasing regulatory and capital reserve requirements, new international accounting standards. What can we expect in the future with regards to the availability of the existing products? Steve, you've talked a bit about the development of new products. Maybe you can expand in terms of will consumers continue to be well served in the future by way of choice and availability with these products, or do you see any gaps or shortcomings?
Thanks.
Just a brief question.
So I'll try to keep it brief. I could take the rest of the day. From a manufacturing standpoint, I think the industry understands the value of the guarantees that we've been able to provide in our products and the fact that they exist in Canada in ways that they don't necessarily exist internationally, and critical illness probably being the best example of where we have a guaranteed product in Canada and we are alone in the world in providing that. I think as a manufacturer, my perspective, again, personal opinion only, is that we're going to hang on to that there's a key value to clients in being able to purchase that kind of assurance and that kind of guarantee. The pressures that are being put on us from a capital and a regulatory perspective, I think, are going to result in that guarantee becoming more expensive. It's been a no-brainer that you buy the guaranteed product. Who would buy a non-guaranteed product when we've been able to provide those guarantees at what has been a relatively low implicit cost in our products? And the regulatory changes and the accounting changes are forcing companies to hold capital and to put a price on those guarantees that we haven't put on them in the past. So I think that's one of the areas of change that we'll see, is that companies will probably bring out non-guaranteed products with a price differential, and clients will indeed have a choice between guarantees at a cost and no guarantees or lower guarantees with a savings component. I think that's some of the innovation we may see. Some of the other innovation is already happening. Kevin mentioned disability insurance that morphs into long-term care. Got it. It's already out there. It's being provided by a number of carriers. Combination products, things like that. Companies are working at the edges and working in the details to try to bring that kind of flexibility and that kind of choice into the products that we have. We haven't done necessarily a good enough job of promoting that relative to what we in this audience have seen as the takeaway of the product repricing that has happened very rapidly in the last 2 years.
Kevin, would you like to comment?
Well, I think when we look back 10 years from now, we'll understand we're sort of in the golden age of the insurance industry, and that a number of the benefits and features you see today likely won't exist the way they are. So I think the challenge or the opportunity for this group now is to go out and inform their clients as to the great benefits available through our products today. Having said that, I have already said this is an extremely innovative industry, and I know we're going to develop new product that will continue to meet the needs of clients in the future. It will not look like, in many respects, the products we have today, and we'll have to probably work a bit harder to position it and demonstrate the value of the product to the client, given those changes.
Kevin, I couldn't agree with you more. I was thinking as Steve was speaking and you were speaking, if we could go out and take some inventory of today's products with the rules and parameters that surround them and put them on the shelf, 5 years from now, the world would be beating a path to our door. We'd be rich beyond belief, I kind of think. Anne, would you like to make any comments on that?
Well, I think the point about innovation is really critical, and I think that I can say certainly I have a lot of confidence in the brilliance of the actuaries that work in the industry. And I do. I mean, it's an extraordinary thing to sit in a room and listen to people thinking up new ideas and have the brains that can do that, which I never understood what you could do with a math degree. So I now understand that.
That's okay, I don't understand law.
I do think there's a really, this industry has always been very creative. I mean, the idea that you could sell insurance to begin with, was, you know, that concept used to be something long time ago that wasn't allowed, and eventually we built a business out of it. So I think there's a natural innovation ability within the industry. I think there's other areas where we have real, we should challenge ourselves to be innovative, and as a lawyer by profession, I feel I can say this, and there are a few lawyers here who might throw things at me, but we, you know, who writes these policies? Actuaries and lawyers, right? Like the wording, the way we describe products. You've heard everybody here today talk about how complicated what we are selling can sound when it's written down. I mean, we've all read information folders, or mutual fund business is the same. We have, you know, miles to go on how to describe what's being sold in a way that is easier for a consumer to understand. And I know how hard that is to do, you know, legally, and have a contract and all that stuff. So that's I think that's a big innovation opportunity waiting as well.
Joanne, do you have anything to add?
I don't think there's much I could add to what Steve and Anne certainly have already said. I do certainly agree with the comments with regards to making the policies more understandable for consumers. And again, that ties into the value of the advice that they're being given.
Well, thanks very much. Next question I'd like to pose to the panel, I'm going to direct it first to Joanne and to Anne. Advisors continue to struggle with the burden of compliance and change. Now, I wish that some of our earlier panelists were still here, because, Joanne, quite frankly, a lot of the burden is not in your area, but nonetheless, they continue to struggle with it. In surveys that we've seen today and seen previously, you can now conclude that there certainly is a value to financial advice. So I'm wondering how you might see the value of financial advice and the role of the advisor going forward, given the kinds of constrictions and the environment that we're looking at now. What sort of changes should we be making or contemplating, if any?
Well, I think the value of advice certainly has never been more important. We're dealing with now a second generation that's grown up with the internet and with social networking sites, and vast numbers of people who will log on to a social networking site and ask 650 Facebook friends for advice. So I really believe that there has to be an education component, that advisors need to focus very much on educating clients and their clients' children and families with regards to the value of advice, and there's a role for regulators to play in that function as well.
Anne?
Well, I think everything we've heard today emphasizes the importance of advice. This is, it just can't be over described. The problem that we have right now is we need Canadians to be planning for their financial future, and we have a lot of them, and the slides from the study we saw earlier show, you know, a very large number of people aren't even seeking out advice. That means they're not even asking themselves the question, should I do something, right? Should I do something now? And that, to me, is a huge issue for us to grapple with, and I will confess I'm not sure where those people fell on this scale that Malcolm was speaking about in terms of the people that are below a certain level where he thinks people shouldn't be saving, but there's still an issue out there for us to grapple with. The people need to get to an advisor, and you know, it's sort of like, do you want to have all Canadians practicing law or doing their books all by themselves with no professional training? It's the same with financial advice. You know, there are people out here that can help, and we need to connect people with the people that can help.
Do you have any comments, Kevin?
Not really, no.
I'll echo the importance of advice. Somebody drew a parallel in one of the earlier sessions to doctors. Lots of information on the internet about medical situations. Most of our clients are not well served to be their own doctors. I think that the complexity of our financial products and the way they can be engaged beneficially in a tax environment and everything else requires the knowledge and the expertise that you people bring to the table, and I don't see that changing.
Joanne, if I could just follow for a second before we go to the audience. In your role in the Alberta Insurance Council, do you feel that the vast majority of advisors today are well-equipped from a technical and a communications point of view and a service point of view, the whole sort of gambit, to provide this expertise now and ongoing?
Absolutely, I do. When you talk about the professionalism in this industry, I can tell you I have been in the regulation field for more than 20 years. And when you look at the statistics, when you look at the number of cases that we have to investigate, when you look at the number of cases that we have to take some form of regulatory action, this industry is highly professional. The number of cases that we have to actually take action on constitute less than 4% of the complaints that we would normally receive. So I would hold those statistics up with that of any professional body anywhere.
Isn't she great? Do we have anybody out there that has a question to ask? Could you go to one of the microphones so we can all hear it, please, if I can ask you to do that? Sir.
How you doing?
Down here. Carry on. You're first down here, sir.
Pardon me?
Go ahead.
Everyone probably heard me speak, but this is one of the most interesting topics I've heard during this whole session. You know, all of you are 100% right, but we as insurance brokers and agents know as much or even more than you people know, because we deal directly with our clients. You people aren't selling the product. You're selling it to the insurance brokers. We are negotiating. We are selling to our clients, who are the people that are bringing in the business to the insurance companies, giving the insurance companies the profits, the monies. You brought a lot of things to my attention, which you're 100% right. And now's the time, since you brought it to my attention, to go out to sell and to sell our clients. Number one, the guaranteed products that are still on the shelf. Sell it, because now is the time, and communicate that to your clients. Everyone here that are insurance brokers or agents have got some ammunition right now. Don't go to sleep. Go out and sell. The other thing is, It's very nice that we got the information from you. Why don't you get the information to your insurance agents and brokers? See what they think. Get their opinions. The government, and I don't understand this. What have we got to do with the government? Why is the government putting us under pressure? Because the government has reduced pensions. They've cut the pensions down. They're saying that people are living longer, etc. Why can't we, as insurance brokers, forget the government? We're not the government. Let's do what we have to do.
Excuse me,
We
but
should have a panel. We should have a panel of insurance brokers to discuss this. I could go on, but I won't. You got the basics of what I'm talking about.
thank you, thank you. And before we get to our next question, our crack staff at Advocis will pass the collection plate.
Chris, if I may, I have
Oh, you have a comment, please?
one comment around that. Guarantees are expensive already. And I understand the merits and I understand the benefit of selling today's guarantees, but that's locking in today's prices too. And one of the things that's happened in the industry in the last 2 or 3 years is we've enhanced the value of the non-guaranteed products. Don't overlook them as well.
Okay.
And have been attempting to educate advisors on that point as well. But it is not the one and only thing that's on our product shelf, and it may not be the right thing for all of your clients.
But since the guarantee is there, let's use it right now.
It's worth considering within the suite of options that are available.
Any other panelists want to comment?
No, I do think that's a good point, because there are options, and there could be, for some of your customers, it might not be the right thing to lock them into the rates that are currently available, when there might be adjustable products that would suit them better. So it is still, again, about what does the customer need, and looking at the products that are available to make sure you're not locking somebody in at a rate that doesn't make any sense for that individual's circumstances.
But if you're locking them in, there's a certain part that's guaranteed. But the guarantee could go, you could still go beyond the guarantee, but the least is the guarantee. That's what I'm saying.
Point well made, thank you. Yes, sir.
Well, I'm just going to add to this gentleman's comments. Perhaps retrospective is in order here. We know this is quite apparent in fraternal benefit societies or still traditional mutualized companies. Given the fact that we got a 200 basis point yield roughly in the bond market for 30 years, why don't we go back and look at making the product shelf that you have now and the product shelf that you have to develop in future have a dividend on it? Why don't we have CI with a dividend? Why don't we have something that's participating? Because of the acute environment that we're in, it would take a lot of the strain and a lot of the pricing headaches away from people like Mr. Krupitz here when we're having to price product with an absolutely historical low interest rate environment. So we do it obviously on things like PerformMax and Optimax on the Empire side. We can do it there. Why can't we extend it to term products? Why can't we extend it to disability, critical illness, and long-term care? Thank you.
Steve, do you want to respond at all?
Do you want to go first or me?
You're the actuary.
So I have two quick answers to that. One is, while it seems an obvious alternative, it certainly is one that's out there, and companies are certainly free to look at it. It is not cost-free, it is not risk-free, it is not regulatory-free. The regulatory pressure and on the governance side of PAR in general has certainly ramped up over the last 3 or 4 years, just as the regulatory pressure has ramped up on a whole number of fronts. So while it may not have been as apparent on the street what the regulatory pressures are on that side, PAR is not immune. And it's under the same sort of pressure. It's not the panacea, it's not the answer. It may be an answer for the right client in the right circumstance. And I think That is the challenge that we're going to face going forward. Will we see that sort of product? It doesn't have to be par, variable, adjustable, repriceable. I think, yes, there's alternatives that the industry will bring forward, whether they're under the fraternal benefit approach or whether they're under a mutuality approach, or just something that is adjustable and gives clients the opportunity to participate, or I should say share, in the experience of the company or the experience of the economy. I think that is where we are indeed going to go, personal opinion. But it will be a challenge because it is not a panacea. Your product offerings, I think, are going to get more and more complex as companies bring out things that perhaps are in that vein or something similar to it, but there's going to be a price to be paid for that. And you're going to have to evaluate the pros and cons of the experience-rated, adjustable, participating, whatever you want to call it, versus the guaranteed versus whatever else is out there. And it's going to be a challenge going forward, I'm sure.
Ann, do you have any comments?
No, I don't really have anything else to add. I think it would be stretching credulity that I could talk about the actuarial issues around PAR, but I do echo the comments about that. You know, it's a very complex issue, managing a PAR block, and not one that I think that is a panacea for everything that we're talking about today.
Kevin?
I echo Ann's comments. Steve's the man.
Ditto for you, Joanne?
No, I wouldn't dare.
Yes, sir, please.
Question for Joanne. It's a compliance issue that kind of fades in and out over time, and that's, of course, the banks and the insurance industries. Joanne, the Alberta Insurance Council was quite famous for quite some time for the Supreme Court case. Could you tell us what the fallout and consequences of that case have been since it went there?
Well, I think actually the most important aspect of that particular case was the establishment of jurisdiction. Prior to the Insurance Act rewrite, the new Insurance Act in Alberta came in 2001, banks were selling creditor group types of insurance, and they were not required to be licensed. That changed with the legislation, and the lawsuit, of course, followed shortly thereafter. All the way through the levels of the Court of Queen's Bench, the Court of Appeal, and through to the Supreme Court of Canada. I think the whole issue was based on who has jurisdiction over the distribution of insurance. And I think the decision was an extremely important one because it very firmly established that the provincial governments have the jurisdiction over distribution, and that set a very clear precedent. Only the banks will, the Bank Act will determine what banks will be allowed to sell. The Bank Act is open for revisions every so many years. The products that they are allowed to sell at this point in time may change in the future, but the jurisdiction has been established that the provincial governments do regulate the distribution. So if and when the Bank Act does change, banks will be subject to regulation in exactly the same fashion as you are, as financial advisors.
Thank you, Joanne. Well, I don't see any other questions. In the interest of moving along, keeping along with our agenda, I want to thank our panelists for being here today. I want to thank them for their candor, and I want to thank them for their style of presentation on these tough and difficult and sometimes a little tedious subjects, but you've enlightened us, and I appreciate it, and thank you very, very much for participating here today.